Hi, my name is Stuart Wemyss and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights that help you master the game of building wealth. And I've got a really important episode to bring you today, 4 property golden rules. Now, over the last decade, I've written about 150 blogs about property investing, and that's enough to fill 4 books on its own. So there's a lot of information there. In fact, over the last sort of 10 to 12 years, I've written about nearly 500 blogs that would probably fill, 10 to 12 books. So it's a lot of writing over that time. And look, in these podcasts, my goal is to, talk about thought-provoking, practical information, sometimes it challenges conventional wisdom, but hopefully all the information empowers investors to make better decisions. And whilst all these episodes around particular aspects around property investing, they are important on their own, I think there's a huge amount of value in kind of bringing them all together into sort of one coherent, hopefully, property investing methodology. And that's what I've tried to do today. Now, there's, as usual, a lot of links to a lot of other sort of podcast episodes and blogs on the blog on the website. So hopefully you can listen to this. It makes a lot of sense. But if you want to delve into, any aspects or parts of it, just refer back to the blog on the website. Link is in the show notes, and all the links to all the previous work is in there. So as I said, I've written a lot about property investing, but what I did is really sat back and thought about what are the few critical elements that people need to understand and that people don't necessarily understand. What are these rules that you absolutely must follow to be successful at building a lot of wealth by investing in property? And so I came up with these 4 rules. The reality is that within each of these rules, there's a lot of work that goes behind it. So there's a lot of analysis or other sort of episodes and blogs and so forth. So you can kind of, as I said, delve into that. But it hopefully just sort of solidifies it into some really basic rules that hopefully are easy to understand, that help people sort of avoid making any mistakes and obviously maximize their success. So let's get into it. I'm going to share 4 rules and then just a couple of observations that didn't really fit in any of these other aspects. Again, just trying to help you make better investment decisions. Okay, so rule number 1 is focus on growth before you buy the property and then income after you buy it. So when selecting an investment property, a property to invest in, growth is the most important factor, more important than income or really anything else. And as much as financially possible, I recognize that, maybe because of borrowing capacity or cash flow or these sorts of things, as much as possible, you should really just focus on growth. And the reason for that is that capital growth is primarily driven by the location of the property, whereas a property's income profile is primarily influenced by the improvements made on that land. And whilst you can always improve a dwelling in the future, you can never improve the land itself in terms of, you can't change its location, its size, its orientation, and these sorts of attributes. Now, if you're being forced into or you're forcing yourself into a strategy such as borrowing to invest in property, and to make that strategy work, you've got to make some significant compromises. So if the only way, putting it differently, if the only way you can invest in property is by targeting a very high yield property, well, then maybe the answer then for you isn't that property isn't the right thing. Now, it's nice to try and advertise a property that is both high yield and high growth, but we know that from previous work that's not going to be the case for the long term. And what we're really trying to do is maximize long-term returns, not really returns over the next just few years. Okay, so how do you do that? How do you focus primarily on growth? Well, you should buy an investment grade property. What is an investment grade property? Well, I'm glad you asked. Of course, there's 3 attributes that investment grade property must possess. The first one is a persistent imbalance between supply and demand. So supply of land should be fixed, meaning that there's no available vacant land nearby. So that's really a well-established blue chip suburb. Demand should be historically strong and diverse, coming from various sort of buyer types. So you want the property to appeal to investors, upgraders, downsizers, and so forth. So that's the diversity of demand. And you want it to be strong, so you want the demand to outstrip supply, of course. And when demand consistently outstrips supply, that's where you get price growth. The second element is you want evidence of past growth over many decades. So past performance is often a reliable indicator for future performance for two reasons. Because value drivers tend to be static and they're factual. So, for example, if a property is located in a well regarded private school zone or a well regarded public school zone, for instance, there's a lot of evidence that demonstrates that these school zones actually drive property price growth and have driven property price growth over the last few decades. That's really a question of fact. Is the school in close proximity? Yes or no? It's a question of fact. And the reality is those things rarely change. I mean, I hardly move schools, right? Never happens. And so you can say, well, this is why this property has demonstrated such strong growth over 30 years. And you can build some confidence of why better growth over the next 30 years might occur again. And finally, the asset must have a strong land value component. So more than 50% of its overall value should be represented in the underlying land, of course, because that's really where the capital growth is going to come from. So persistent imbalanced supply and demand. So that means location where there is no supply of vacant land and very strong, well, and diverse demand for property in that location. You want evidence of past growth over multi-decades, and then you want strong land value component. Now, it's interesting. I looked at a property for a client. So it's an existing client that held this property, and myself, Campbell, and Jim were talking about it last week. It was located in Geelong in a terrible suburb. So I know Geelong relatively well. I grew up there as a child, went to university there before I moved to Melbourne. And when you look at the past growth, you go, wow, that's pretty good. And it is good. The problem is, I'm going to get to it in one of the other rules, is that growth can't continue. So not only is it a case of thinking about looking at past growth, but you've also got to form a view is, can it continue? And that's, I'll get to that in a second in another rule. So when a client goes and buys an investment property, we encourage them, counsel them to spend most of that budget on just buying land. Buy as much land as you could possibly afford in the best location that you can afford. And just make sure that the dwelling is tenantable. It doesn't have to be, fancy or great. We can always improve it down the track. Let's spend most of our budget on the underlying land value, because really what we want is capital growth. Now, once you've done that, you've bought the property, you've been solely focused on growth, your attention should dramatically shift to focusing on minimizing the holding costs. So that can be achieved by either increasing the rental income by making maybe cosmetic improvements, having the property well managed, etc., minimizing the cost of debt, so interest rates really, optimizing taxation outcomes, which obviously minimizes maximizing negative gearing to minimize your after-tax costs, these sorts of things. You should become really focused on cash flow at that time, but before you buy the property, it's all about growth. And so applying that rule, really critical to make sure you don't, because you're going to have to live with the asset for as long as you own it. You're going to live with those outcomes. If you end up buying the wrong property, you're going to spend the next few decades regretting that decision. The second rule is it's important to understand property cycles. Now, it's important, but not critical, because you can buy the right property, but at the wrong time, and it can still work out well in the long run, but you just have to hold the property probably for more than 2 or maybe even 3 decades to achieve the average return that you expect. So buying the right property wrong time, it will work, but it'll take longer to work. On the other hand, if you buy the right property at the right time, it can be incredibly valuable because it'll allow you to achieve your goals sooner. You can use the equity in that property sooner. It'll make you feel more comfortable, of course. It's nothing better than buying a property and seeing a lot of growth in a relatively short period of time. So, for example, around about 2018, we started advising a lot of our clients to buy investment grade property in Brisbane, because by around 2018, the Brisbane market had already experienced about an 8-year flat cycle, and flat cycles tend to last about 7 years, so a little bit deeper, longer sort of flat cycle than usual. And there were signs that the market was changing. That is, one of the key indicators for Brisbane was interstate migration, and really is a good metric for overall sentiment. Well, interstate migration into Queensland and Brisbane was negative for a long period of time and then started to really turn around. And its long-term trend was always positive. So we thought that was changing. So clients that spent around $1 million in 2018, 2019, those properties today would be worth about $1.7 million. So that's about $700,000 equity over a relatively short period of time, 5.5 years. I say relatively short for when it sort of comes to property, but they're off to a great start. And for those people, they'll be able to utilize some of their equity to buy more property, to make other investments. Those assets now stand alone from a debt perspective. There's a lot of positive outcomes as a result of that. So being aware of growth cycles is really important because it will help you potentially identify a location and property types that are just about to enter into growth cycle or only have just recently entered into a growth cycle. Of course, it's not a perfect science, and there's going to be unforeseen factors that, are going to impact future returns. So it's absolutely critical you buy the right property, but if you can try and buy it at the right time, that's really good too. And so I'm not saying it's a perfect science, you can do it in every situation, but it's better to think about cycles than not. Now, I've shared a chart that distinctly shows that property moves in two distinct cycles and has done since, dating back to 1980 when the data began. And I've updated that chart and I share it on the blog on the website, so you can have a look at that. I also, earlier this year, did an analysis between all the growth and flat cycles and concluded that it was a very strong sort of data that showed that growth cycles tend to last 10 years, flat cycles last about 7 years. So over that 17-year period on average, you'll get one flat cycle and one growth cycle. That's where you'll get sort of 6 to 7% growth over that period of time, actually probably closer to 7%. From a compounding capital growth perspective. So you really need those two cycles to achieve the average rate of return. If you can get that growth cycle at the beginning of the investment period, the better off you'll be. Now, of course, not only do geographical markets behave differently at different times, which is kind of surprising, I guess, to some extent, because there are national settings that impact property, like interest rates are the same between Melbourne and Perth, for instance. And the broader economies, economies can be different, state economies can be different, but the broader Australian economy affects, sort of all property. But the reality is that geographical markets do perform differently, and that's mostly sentiment driven more than anything else. So it can be things like taxes, as we're seeing in Victoria, or population growth. But generally, I think it's really around sentiment. But also property types can behave differently too. So if we look at Brisbane again, as I said, houses started to really begin growing or enter a growth cycle at the beginning of 2019, whereas apartments didn't enter a growth cycle until March 2021. A couple of different reasons there, but again, you can think about not only locality, but then also property type when it comes to growth cycles. So first rule is think about growth before you buy and then income after. Second rule is it's important to understand growth cycles. And rule 3, understand the maths behind success. Now, I don't want those people that aren't really into maths or not very good at maths zone out here. I guess, the maths behind it is the evidence-based approach. So one of the good things with mathematics is that, I can prove to you why a particular approach or a particular combination of factors will result in a better outcome. It's not just my opinion. So that's why I sort of talk about maths, but we could substitute the word evidence-based in there. So understand the evidence-based mechanisms behind success if you really aren't into maths. So you don't need to become a maths genius. You just really need to understand the logic behind this approach. Now, the reason why borrowing to invest in property works, in terms of when I say works, builds substantial wealth in dollar terms, isn't because property itself is so inherently wonderful. It's necessary, but the reason why investing in property works is because a combination of specific investment characteristics. And so if you firstly understand and acknowledge that these investment characteristics are actually contributing substantially towards generating a lot of dollar value wealth, then it allows you to work out which characteristics then I need to really focus on. And so there's three characteristics. The first one is that you've got the ability to borrow the full cost of the property, so you don't have to put any of your own money in. And that's really critical. Obviously, banks are really keen to lend against property, not as keen to lend against shares. So I can go and buy a property as long as I've got equity in other property. I don't have to I can borrow the full cost as well as the stamp duties and so forth. Don't have to put a cent in. Second is negative gearing benefits. The negative gearing benefits associated with gearing means that it reduces the amount of money I ultimately need to put into a deal. So I can go and buy a property, I borrow the full cost, I haven't put any capital in. But of course, then I've got to pay for the holding costs, because obviously the interest and expenses are going to be more than the rental income. The benefit of negative gearing is if I'm on the highest marginal tax rate, is that the federal government essentially pays half of those holding costs, really, but through lower taxes. And that contribution is critical because it means I need to put less of my own money in. And the third element is that investment grade property returns primarily consist of capital growth with very little income after expenses. If you think about a property, even if a house might yield sort of 2.5%, but you're going to have probably about 1% of expenses. So your net rental income yield's going to be 1.5%. It's not a lot of income from an asset that's very land heavy asset. Most of my return is going to come in capital growth. So if I get 7% growth and 1.5% net income, I've got an 8.5% total return. But because 7% of that is come from capital growth, 7% divided by 8.5 total return, 83% of my return has come from capital growth. So that you need to optimize all three of these attributes. Let's talk about them each in turn. So, of course, as I said, you can borrow to invest in shares, but borrowing to invest in property has three key advantages. Firstly, it's generally more cost effective. So interest rates for investment mortgages are lower than, say, margin loans. Secondly, there's no margin calls. So if the value of your property falls, as long as you keep making the repayments against the loan, nothing happens. But when you have a margin loan and the value of the market drops, you can be subject to a margin call. And lastly, residential property has half the rate of volatility of shares. And so most investors are more comfortable to borrow 100%, so the total cost associated with investing in property, and that's an important attribute. Secondly, when it comes to the holding costs, if you borrow the full cost, there's no capital outlay, as I've said. So your only capital you're injecting into the property is the after-tax holding costs. And so taxation can be a big element of that because if you're on the highest marginal tax rate, half of that will be paid by the federal government. That's really important. And then having 80% of your total return delivered in compounding capital growth is incredibly valuable as well. Albert Einstein was famously called compounding interest the eighth wonder of the world. It really is. And if you achieve a 7.2% average capital growth rate over the life of owning a property, it's going to double every decade. That's going to do all the heavy lifting in terms of building wealth. So the formula success for property success is very, very simple, evidence-based formula. Borrow the full cost, maximize your negative gearing benefits, minimize all holding costs, and maximize your long-term capital growth rate, which is really refer to rule number one. And that's why all of these rules are important by themselves, but putting them all the full four rules together is what's going to help you achieve property investing success. So just to recap, and I'm sorry for hitting you over the head with these things, but really important. Rule number one, focus on growth before you buy and then income after. Rule number two, it's important to understand property cycles. Rule number three, understand the maths behind success. And rule number four is consider future buyer capacity. And I think this is one that I think trips up a lot of people, and this is where a lot of mistakes are made. So the rule that property prices cannot grow faster than buyer capacity might seem like an obvious rule, but the underlying implication is absolutely fundamental. That is, you must consider who the potential future buyers of that property will be down the track and how their financial capacity to be able to pay more for that property might change over many decades. Putting it differently, you need to ask yourself, will they be able to afford to pay twice as much for this property in 10 years' time and 4 times as much in 20 years' time? That's assuming, again, a 7.2% annual growth rate on average over that period of time. And you need to really consider what's the likelihood, who are these buyers, what is their profile, and how likely is that to happen. Now, economists often argue that property prices can only grow in line with incomes. And of course, that's true, right? If your income rises by 10%, then your borrowing capacity also rises by 10%, allowing you to pay 10% more for that particular property. However, the reality in wages in Australia have only grown at 3.1% over the last 3 or so decades. Now, that's the wage price index by the Australian Bureau of Statistics. So it's a very macro level, but let's say 3 to 4% as a range. So if incomes in Australia have only grown at 3 to 4% over the last 30 years, why has property grown at a much faster rate? And property's grown at sort of circa 7%. So it's almost grown at double the rate of incomes. How has this happened? Because we need to think about this, and we then need to think about, is it likely to change over the next 3 decades? Okay, so there's 3 reasons I think why this has occurred, and this is just my reading of it. Of course, other people might have different views of this, but the first one is credit policy changes. So banking deregulation occurred in the 1980s, and really over the 1990s and 2000s, borrowing capacity changed a lot. Credit policy changed a lot. Competition in the mortgage market changed a lot. And really borrowing capacity, if you compare to the beginning of the 1980s, by the end of the 2000s, borrowing capacity had increased by 2 to 3 times. So people were able to borrow, leverage their income by a greater extent, 2 or 3 times to the extent. Now, credit policy has changed a lot and tightened a lot since 2017, but households can still borrow around about 5 to 6 times their annual pre-tax income, which has obviously continued to support price growth. However, I don't think this attribute is going to repeat over the next 3 decades. So certainly was prevalent over the last 3 decades, 100%. But I think borrowing capacity is likely to remain stagnant at best over the next 3 decades. The second contributor is kind of the urban sprawl. So typically, and this is a very this is a generalization. It's going to be different. Obviously, it doesn't apply to every single location, but typically, when property prices in outer suburbs reach kind of the median level, so around about $1 million, affordability becomes a constraint. And as a result, buyers are then sort of pushed out into sort of new greenfield suburbs, so new build suburbs and estates where property is more affordable. And typically in the first land release with a house and land sort of package, you might be able to buy something like that for, $550,000, but a lot more affordable than the median price of $1 million. As these estates become more established and prices start to rise, and they become, that they have a supermarket and then they have a doctor's surgery and a dentist and maybe even a school. So as they start to get built out, then the prices start to reach that median again. Houses start to cost $1 million. That ripple effect continues. And certainly you can observe this. And so when you look at that price growth, when the new suburb was just started versus 10 years later, you can go, wow, look at that price growth. They cost them $500,000 and now they're $1 million. That's 7% growth. But what's happening really is that ripple effect continues to ripple out. And there's more and more newer suburbs are created on the outskirts of, particularly in Melbourne and Brisbane, it's happened a lot. And I think that contributes to property price growth as well. And the last element is wealth inequality. It just gets worse. It gets worse in all Western developed nations, really, and Australia's not different than that. that the wealthiest 25% of Australians are a lot less dependent or reliant on family income alone in terms of their capacity to buy property. They tend to have other sources of wealth, whether that's business, inheritance, employee shares, these sorts of things that allow them increase their affordability in terms of and capacity in terms of buying property. And that's going to continue. So wealth inequality is just going to get worse. There's really nothing that's going to probably change it, unfortunately. And it sort of shows in a recent study, the top 10%, their wealth in Australia grew by 84%. So their net wealth increased over the last 20 years from 2.8 to $5.2 million. Whereas the lowest 60% only grew by 50%, 55% over the same period of time. So it's really that wealthiest 20 or 25% where their capacities aren't linked to incomes. Now, here's the really important thing to think about. The media often bangs on about housing affordability or lack thereof, that few people can afford to get into the market. Houses are becoming less and less affordable. Now, if that's true, how have property prices risen so much over the last 40 years? How have property prices continued to rise? How have property prices in, say, Brisbane and Perth, how have they risen, and Adelaide risen so much over the last 5 years if property is unaffordable? The reality is that housing is affordable to certain segments of the population. And so it's vital for investors to understand who those cohorts are and to invest in locations that appeal to them. Because credit policy probably won't contribute towards capacity as it has done over the last 3 or 4 decades. The urban sprawl will continue, so there's going to be new build suburbs, where the entry price is 500,000 or 600,000, and in 7 years' time, those properties are going for $1 million. But the buyer capacity, the people that are buying property in those locations, their income isn't growing by 7% per annum. So and they don't tend to have typically other sources of wealth. So they don't have the capacity to continue to push those prices along. Unfortunately, once it gets to the median value, it'll probably just ripple out again. So the only answer then is this wealth inequality. That is, invest in locations where the wealthiest 25%, 25% of Australians really want to be in, because they're the ones that have got the capacity to push property prices forward. So that's why rule number 4 is consider future buying capacity. And specifically what you need to do is think about in 10, 20, 30 years' time, who's buying this asset? Who's the cohort? What is the demographic? And why do I believe they can pay 2 or 4 times more for this property over that period of time? Where will their capacity come from? It's a really critical element to think about. So again, I'm going to summarize them before I get into some other observations. The first rule is focus on growth before you buy an income after. The second rule is to understand property cycles. The third rule is to understand the maths behind success, which is really full gearing, minimize holding costs, and generate as much compounding capital growth as possible. And the fourth rule is consider future buying capacity for the property that you're investing in. Now, I did want to just share 4 other observations. Didn't really necessarily fit into any of these 4 rules, but just observations that I often kind of refer to during conversations at work within my team, or if I'm talking to clients. Okay, the first one is maximizing negative gearing benefits is more important than minimizing capital gains tax. So that is a tax saving now is far more valuable to me than one in a few decades' time. And so when we model these things out and then look at, what is the time value of money and how does net worth in today's dollars change, time and time again, we realize that maximizing those negative gearing benefits is the key element. Even if we pay, the kind of full whack of capital gains tax, which is really 23.5%. That's the most you'll ever pay in your personal name. well, then so be it, because we might not actually have to pay for that tax liability for 20 or 30 years, or maybe not even ever. And that analysis was quite clear in that episode that I record about investing in superannuation inside a self-managed super fund. That is where you've got lower negative gearing, but then you've got a potential ability to avoid capital gains tax. Second observation is a company structure can be good because it can help you maximize your negative gearing, avoid paying any land tax surcharge, but whilst also minimizing capital gains tax in the long run, maybe about 30 odd % saving in terms of capital gains tax liability. So that can be a worthwhile thing to think about. The most effective property investments, and when I say most effective property investments, I'm talking about an investment that generates the highest dollar value pool of assets after tax. And that's the key thing, right? You want to invest in property today, and if it puts $2 million in your pocket after tax in 20 years' time, that's a pretty good outcome. $2 million will go a long way to helping people fund retirement. So the best property investments are those with the highest negative cash flow after tax, whilst also the highest internal rate of return. Now, I keep talking about minimizing holding costs, and you should minimize them as much as possible. But if I'm earning a very high internal rate of return and I'm investing a lot of money in that investment, then I know in 20 and 30 years' time, I'm going to generate a substantial amount of money. So let me try and give you an analogy. If I said I've got two investments, right? One investment you can contribute $20,000 a year, and I'm going to give you a 10% return. The other investment you've got to contribute $50,000 a year, but I'm going to give you a 15% return. Of course, that second option is going to be more attractive, not only because you get a higher annual return, but you're forced to invest more each and every year. It's going to absolutely dwarf the first option. So an internal rate of return calculation is important, but it's also important to understand how much dollar value wealth will that create. Because a property with a really good internal rate of return, but a very low amount of cash contribution I need to contribute, is only going to generate a relatively low amount of dollar value gains. Again, if I've confused you, I apologize, but there's links into the relevant episodes that I've spoken about these particular observations. So if I have confused you and want to unconfuse yourself, go to the blog on the website and follow those links. Okay, last observation is from a recent episode, and that is investing in property outside of super tends to be the most optimal approach. As I said, you need to maximize negative gearing. It does that. You've got control over the asset. You've got a higher rate of gearing. You've got lower borrowing costs outside of super, right? So if we're going to invest in property, borrow to invest in property, outside super is the way to go. However, having all your assets or a lot of your assets invested in the property market doesn't necessarily, unless you've got a lot of wealth, doesn't necessarily allow you to maximize the tax-free benefits of super. So there needs to be some sort of switch, some sort of plan on how you're going to move tax effectively as possible. How are you going to move that wealth that's currently in your property portfolio, will be in your property portfolio, into the super system so that you're maximizing the tax-free benefits. And the tax-free benefits are $2 million per person. That's tax-free. So if you've got a spouse, that's $4 million of your net wealth needs to be in super to be as tax effective as possible. Okay, I've gone over time, but I think it was a really important episode to share with you. If you know anyone that's interested in investing in property or building wealth through property, please share this blog. This might be, a particularly helpful blog. Hopefully, you put all these 4 rules together, it really will help you make a much better decision. And that's the aim of not only this episode, but obviously this whole podcast. And until next week, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.